Good morning, ladies and gentlemen, and traders around the globe. We from Admiral Markets say welcome to our real-time daily trading idea webinar. It's a new trading week, and yes, we would like to screen the markets here, show you some interesting trading setups, and for sure answering your questions. But first of all, here's our risk disclaimer, so please be aware that all we are showing and presenting here is just a personal opinion of our traders and not an advice for investing. So, and also here, just a quick overview of the ESMA regulation. It starts from last year in August, and as you can see here on the slides on the right side, we have the leverage reduction. And what does it mean? As you can see here, also on the margin levels. But you have different options here. Maybe, for example, you are able to enter the professional client status. Here on the right side, you can see what does it mean in detail. And for more details, you can also contact our customer service. Here we have a picture for me. My name is Tim Chamber. I'm an account manager from Germany here in Berlin. And yeah, we have the pleasure here today with Jens Klatt. He is not here on the slides because normally Jay is here at the stage, but Jay is unfortunately sick today. So yes, we have the pleasure here with Jens Klatt. He is also another famous trader here from the German area. So here I have a quick overview of some of our offerings. For example, here our DAX, our bestseller, the DAX 30, with a typical fixed spread of only 0.8 point during the main trading hours. These and other products you can trade without any commission. So, and yes, you have also here on the right side our awards from our customer service and also for all our products. For more details, you can also check out our website. Here you have one another slide for One World Global Offers, because we are international broker and we have different licenses all over the world. So what does it mean in detail for you as a customer? You can also ask our customer service as well. So that's it for me for the moment. I say good morning to you, Jens. Hope you're doing well, and yeah, thank you that you are joining us here today. For Jay, because he's sick, and yeah, we are looking forward to what you told us about the markets today.
Yes, good morning also from my end. Thank you for the very, very nice introduction. And now you should see my screen. So this is my face and to the voice. And nevertheless, let's switch right over to the markets. I think we have a very, very interesting potential setup, let's say, one which I presented over the last month already several times. It's in the EURJPY, was already triggered, in fact, but currently we get to see a retest of the breakout region. The setup here, I've written it down, there you can see it. Yeah, I just waited for it, to be honest. So Darshan just wrote lots on yens and yen, so JPY yen. Yeah. In fact, there have been plenty of occasions when I was talking about the JPY, talking about the yen's performance, for example, and then but that's a different topic. So yeah, let's have a look here at the setup. So it's a classic Asia breakout system, in fact, which is purely statistical, in fact. So there have been questions around technical levels which are considered or not, and in fact we are really ignoring any technical levels, purely statistically based. It's over nearly a decade of a backtest result here, and the setup itself played out really well over this time span. And so what we do is, in fact, we look at the high and low. You can see it here when looking at the chart. This is the high and low in the time span between 3 a.m. to 10 a.m. German time in this case. And then we use the purple line, which is an exponential moving average 11 as a trade filter. And the setup goes as follows. If we break out on the upside while trading above this purple line, we go long. If we trade below and break out of this range, then we trade the short side. And today, as you can see here, the setup was already triggered. That was, is around 1 hour ago. The high low can be found between 124.58 here. This is the high, and then the low 124.34. And then the entry long here happened at 593. So there was some slippage on the upside, and I will present to you the reason for that. So the reason for the push higher is probably mainly based due to the performance in $JPY, while EURUSD stayed, let's say stayed, because as you can see here, we are right now dropping back into the range, and the reason for that is most likely that, let me just switch over here, that the EURUSD, there we go, just dipped below 113. So why do I talk about EURUSD and $JPY when we are looking at EURJPY? It's very simple. EURJPY can be also shown as EURUSD multiplied with $JPY. So as you can see here, dollar is in Germany we say Kürzen. I don't know the English explanation, English word for this, but these USD is just they just take each other out here, and then EURJPY is what's left in this case. So if EURUSD is stable while $JPY shoots up, EURJPY should follow. Not as strong as $JPY in this case, but nevertheless it should also push higher. And right now we see $USD being stable while EURUSD is dropping, which means EURJPY should drop then. Yeah, so in this context, nevertheless, the setup was triggered on the long side. Hopefully will play out. Right now it doesn't look that as it will play out, but the setup was already triggered at 24.593. Then we have our stop at 124.34, so we have a risk of 25.3 pips. And then what we do is, and there's where the statistics come into play, we have to multiply our risk here with 1.7 to get our target. So that means we multiply 25.3 with 1.7 and we get 43, and we add those 43 pips then here on the upside on 124.59 and get out at 125.023 in this case. But let's take out the fractional pip here in this case. So we get a risk reward of 1 to 1.7, and yeah, that's in fact my setup for today. So around EURJPY, and in fact, since it was already triggered and since it's a make or break approach, which means EURJPY makes it to the target or breaks lower and we get stopped out, we can't do anything on top here, but just just wait whether it plays out or not. That's all we can do right here. But nevertheless, I want to switch over to $JPY. There we have it, to show you the push above 110. There were several times when we failed to break. Oh, let's probably go to the hourly chart. It's probably a little better. 1 second. So we failed several times to make it above 110 in the past, as you can see here. So there have been several cash-ins. That was here already we're into the last week of January, that we failed to break higher above 110. So we topped out at 109.90, 109.95. Then we slightly pushed above 110, but were sold back below 110 soon after, topped again against this level, and then today there was this push higher. I'm not sure whether it's really let's call it a risk-on move which is taking place here, even though, for example, some of you probably have followed the price action overnight in Swiss franc too. So some of you, even though it's not one of the most traded currency pairs, but dollar Swiss franc, for example, showed a squeeze of over 1% overnight. So we have a very thin market environment here. When the trading week starts every Sunday, Sunday night then, and there was, it wasn't really a flash crash because dollar Swiss franc pushed higher, but nevertheless there was some illiquid market environment which resulted in this push. Shortly after, 30 minutes later, we traded back where we started around the parity, so dollar Swiss franc at 1, and right now we see a drift higher in dollar Swiss franc. So The same is true here for $JPY, and if we combine this with the DAX and the start into the week and the push back towards and above 11,000 points, one could come to the conclusion that's probably kind of a risk-on move. I don't share this thought, to be honest, because I think it's mainly due to a quite illiquid market environment we get to see here. That's something we can see in a few minutes then when looking at the DAX, for example. And there's also a bank holiday, if I'm not mistaken, in Japan today. So the combination of illiquid market environment and this drift higher here is potentially resulting in this push above 110. But what's probably more interesting is the fact that if we go back to the daily chart, that you can see that we are probably not yet done. So there's some room after clearing 110 here on the upside. There's definitely some room on the upside, which could push us probably here to this, in this case, also purely technical level. When you put in the Fibonacci levels here from the yearly highs of 2018 to the lows then here, which is, by the way, also these flash crash lows, we have to call them. There was a flash crash in JPY on the 2nd of January, but it's corresponding here, as you can see, with the lows from 2018. So if you put in the fib levels here, what you can see is that now there's the 61.8 level here on the upside, which can be found around 110.70, which means there's probably, from this perspective, some further room on the upside. I have to be honest, I'm a little more positive. In fact, I could imagine here, especially if the overall market environment stays calm, we don't get to see risk-off moves or nervousness among market participants, any kind of anxiety building up, but everything stays calm, while probably also U.S. yields can stabilize. I think that we have some room then, probably up to 111.50 here. So it's probably a very significant break, and within the next days to weeks, probably further room on the upside is given, and we have a solid chance to probably make it back above 111 here. So in $JPY, I definitely, not only today but over the days to come here, after the break above 110, especially if we can close today above 110, I think intraday long engagements in $JPY should be favored here too. So then let's have a look here at EURUSD. There, the picture is not very spectacular, to be honest. So it's a very, very volatile market environment, but we are currently drifting towards a quite significant region, in my opinion. When looking at the daily chart, what you can see here is the region around 1270 to 1280. So if we break below that level, and then looking, I haven't prepared the chart, by the way, but look it up yourself after this event probably. Just open a dollar-Swiss franc chart, and then you will see the push among or around 11 p.m. German time. So this is 10 p.m. London. You can see a sharp squeeze on the upside, and then it was sold back again. Why I think it's important to mention this is not because it was possible to trade this setup, but it's more very good idea you get of how illiquid the current market environment is. And when looking at EURUSD then in this case, and when looking at EURUSD, we know that this is one of the most traded currency pairs around the globe. Well, the thing is that this region here is definitely a region everyone can really see and everyone can spot, which means that once the EURUSD drops below that, and this drop below, or this oversupply then hitting the market, could, in a thin market environment, really result in such a sharp move, in this case then on the downside in EURUSD, and something you have to remind yourself of, in my opinion. So be really, really careful when EURUSD drops into this region here, especially with this illiquid and volatile tendency we currently can't see here in EURUSD. Yeah, so that's it on EURUSD, and now let's have a look here finally at the DAX and what happened there. So in fact, usually I mark the so-called open range. In the DAX, I do this between 8 to 9:05 a.m. German time. Today, I just skipped this open range because it didn't make sense to me. The overall open range here was below 0.2%, and this is a filter I have So I want to have a difference between the high and the low in the DAX in this case. So I'm not using this filter approach in EURJPY, but I do it in the DAX. I want to see, based on the current index reading, that the range is minimum 0.2%. In this case, let's go back here to the Word document and probably do it that way. So that means nothing more than I have to multiply around 11,000 with 0.2%, which comes down at 0.002. And then we see that it's 22 points minimum, min range we have to have. And in the morning here, we saw that this wasn't the case. So the range was in fact only 21 points. And yeah, we broke out on the upside of this range. And we pushed now back towards 11,000, and let's see whether further momentum can be taken on. Why the current region is noteworthy, in my opinion, can be seen here when looking at the hourly chart. This is the direct dominator of the 5-minute chart, and the thing is that even though it's not a very significant region, it's nevertheless a region which could result in further gains on the upside for the bulls. If we can clear 11,030, the current region we are trading in, respectively 11,050 points, further room up to 11,100 to 11,130 points is given, in my opinion. Nevertheless, after especially the sharp drop we've seen on Thursday and also the drop below 11,000 points then on Friday, the overall mode is not very positive anymore. And many, or much currently, much depends on how the talks between China and the US go in terms of trade. So any sign which is showing that both sides do not find a solution, no agreement, is or should be considered a potential risk-off driver. Not sure whether this will happen today. I think this is, in fact, something we shouldn't really expect. Economic calendar is quite thin, and today we shouldn't expect any news here from the, let's call it, trade war front. So what I would say is currently the overall advantage in the DAX should be seen on the long side, especially as long as we can trade above this. Also here, purple line. The purple line is the EMA 50 in this case. So it's my not only trend filter when it comes to trading, but it's also my indication for the overall advantage in the over the day, intraday in this case. And as long as we trade above that, we shouldn't be overly excited about short engagements. This is also true for the direct dominator. So which means I can identify a short trigger, let's say, on the hourly chart, but I'm not trading the short trigger or the short side here, as long as on the 5-minute chart, the time frame where I bring up my trade then is still showing a long tendency. But I have to see that here's also a clear break to be found, which means that then further losses seem likely. And yeah, so that's it on the DAX then. I just take the chance to answer some questions probably.
Yes, Jens. We have here a question about the flash crash in the Japanese yen pairs. So you told already there because you're showing us these candles. So yeah, maybe you have an answer why this crash is just coming there on this time.
So I think it's mainly liquidity driven. So which means we can see those flash crashes happening. It's not JPY or only JPY. In fact, probably it makes the most sense to go over to the website because I know that there has been a really great article here in the traders blog on where I'm, by the way, currently in. So here, analytics and traders block, you can look it up yourself, and then you have to search a little, but I'll do the search here. Probably it's page 4, 25th. Okay, then it's probably, so I search, and while I search, I keep on talking. So it mainly has to do with liquidity. So if liquidity is thinning out, then we have a chance that a small order can trigger a big rise or drop in this case in whatever currency we're looking at. So here, yen flash crash hits currency markets. I click on it, I share the link here, and there you can also find potential reasons which so there's the link in the chat box, which was the driver for that. So on that day, in fact, there was a news which then became, by the way, a fact shortly after. So last week, was it, or the week before, when Apple announced its Q4 earnings there was already a hint given by the CEO from Apple, Tim Cook, on the, I think was the second, it was the second, from the second into the third, or onto the 3rd of January. That was a potential trigger event. So markets were hit by this news by surprise, because it was the first time for almost 12 years here in this case, that Apple announced such a warning on their future revenue. So that's not happening very often in terms of Apple. So, and that was the trigger event, and then this trigger hit a very thin market environment and triggered a cascade of then, in this case, sell orders hitting the market. And this accelerated itself. We got a domino effect. And then there's another thing which is very, very important to note. So when looking at, for example, algorithms, we're most of the time talking about algorithms delivering liquidity, so especially high frequency trading algorithms. But in fact, they're not really delivering liquidity, but it's some call it fake liquidity. So those algos may be in the market, and you may probably see orders they give in on the bid, respectively on the offer. But the thing is, once volatility hits a certain threshold, and volatility rises, and so the risk of being caught on the wrong side rises, those algorithms have a tendency to take out their limit orders on the bid, respectively on the offer, which means it's kind of fake liquidity, because there's no real market player in the market anymore who can then equalize such an oversupply, in this case, coming into the market. And this is then adding to the cascade, because the higher the volatility rises, the more algos step back and wait till the liquidity comes back into the market, respectively volatility drops again. And this is then adding to this overall sharp dropping tendency, in this case, what we all know as, or in short, as the so-called flash crash. Oh, I see another question. So probably it's on the Dow Jones. So probably I use the chance to switch over to the Dow Jones here.
Yes, please.
So to be honest, I'm very, very skeptical about this move higher here. It doesn't look very. We all know what's driven this push higher. Let's put it that way. So we know that, first of all, we have to probably start a little earlier. In October 2018, the Fed started to be really skeptical. Not skeptical, but they were talking about yields being way below the neutral rate. The neutral rate is the level where the current yields are matching the overall economic outlook of the Fed, let's say. So, and when they talked about the yields being way below this neutral rate, market participants were expecting further rate hikes to happen in 2019. So just to make sure that everyone gets what I'm talking about, here, that is nearly 3 months ago, markets were expecting 4 further rate hikes in 2019. So March, June, September, December. To make long thing short, this probability has dropped to 0 right now. So within 1 quarter, 4 hikes became, or the expectation of 4 hikes became 0. And so now the interesting thing was that there was also a communication from the Fed then in December, where Jay Powell not only talked about further rate hikes, but also about an automatic balance sheet runoff here. And that resulted in, turbulences, which put a lot of pressure on the market. And around Christmas, then there was the U.S. Treasury, Steve Mnuchin. He came out with the news that he just spoke to some CEOs from Wall Street, and also here not only that, to make sure that there's enough liquidity just to overcome any liquidity shortage and potential drops, but also that he has spoken to the so-called plunge protection team. And the plunge protection team was brought to life shortly after the October 1987 crash in the 1980s with Reagan. I think Reagan was the one who just signed this deal back then. So why do I mention this? Well, because this move higher here looks very manipulated, let's say. So I really don't see any fundamental change. I mean, sure, there's now some kind of Fed put being in play again, with Powell announcing that, or the Fed in this case, the Fed Chairman Powell announcing that there's no real automatic runoff of the balance sheet anymore. Then rate high expectations drop to zero. So from this perspective, the overall picture looks solid again. On the other hand, we have to remember ourselves that there are still these negotiations around the trade war between the US and China. And with this in mind, this move here looks a little extended, let's say. And I wouldn't be surprised to see a sharper drop on the downside rather sooner or later. The only thing we need is a trigger event from outside. Nevertheless, we can say that everything taking place above 24,250 points here, 200, 250, 300 points, is definitely something we can consider bullish. And we should be really, really careful with short engagements above that level in the Dow Jones, since as long as the Fed, respectively also the plunge protection team, are holding the Dow at the current levels, I think we just shouldn't fight those forces in the market right now. Nevertheless, if there's rather sooner or later a break lower, the line in the sand, in my opinion, is 24,200 around. If we drop below that, further losses become very, very likely. Yeah.
Okay. Great. Thank you for showing us here interesting trading setup and explaining the condition of the markets. So we have a lot of great feedback from our listeners. So we do a great job, I think. And thanks for all listeners as well here today. Who has joining us, and we see us tomorrow if you like. And Jens, you have these daily outlook on Friday, if I think right, and so yes, you can join this in this webinar as well. So that's it for the moment for us. So I give back to you, Jens, if you would like, for some last words, and wish you all a good trading week. Bye bye.
Bye bye also from my end.